All right, my Econ students, we're back again. Our last section of notes. Fun fact, this is the last true section of notes we're ever going to do. Again, I wish we were doing this in person. I miss you guys like crazy, and I wish we could have a little celebration over the last notes you're ever going to take for my class in high school. We still do have a worksheet coming up next week, but as far as this is concerned, this is the last thing we're going to do. So, we're talking about trade account balances. If you remember the last time when we talked about arguments against free trade, one of the arguments was that, well, it could create trade deficits. And the concern about trade deficits, of course, is that the money is going to leave our country. And I said, hold on to that thought, because I'm going to show you here how the trade always balances in the long run. In other words, that money makes its way back, and that's what we're going to see with this. Honestly, this is a really quick, really simple lesson. It's not going to take me too long to run through trade account balances, just understanding the definitions and how they balance. It's pretty simple. So, there are two types of trade accounts. When we make an exchange with another nation, it gets credited in one of two accounts. The first account is what's known as the current account. The current account, it measures the exchange of goods and services between nations. So this is pretty simple. Think of it as if anything that's made in one country and then sold to another country, that goes in the current account. Okay, so when we sell agricultural produce to other countries, when we buy tea from England, when we buy maple syrup from Canada, whatever, all those things go in the current account. The current account measures the exchange of goods and services. Okay, make sure you know that. The capital account measures the exchange of investments. By the way, that's a terrible underline, really crooked. Anyway, capital account measures the exchange of investments. Nations invest in one another. Most commonly, nations will buy stocks and bonds from each other. Okay, that would be an example of an investment. But it also includes if one nation is going to go into another nation and invest in real estate, in other words, buy property. If one nation is going to go into another nation and build a factory. For example, we have American factories that exist in other countries. We've taken our money and we've gone over to other countries and we've built shoe factories and whatnot. Other countries do the same thing here. Toyota, for example, has taken their money, come over here and built a car manufacturing plant in Georgetown as well as other places. Those are other examples of investments. So it's anytime countries take their money and bring it into another country in order to invest or buy something that they consider an investment. So that's the capital account. Okay, so it measures the exchange of investments between nations. Okay, so that's pretty simple. Just know the definition of the two. Now, here's the trick with the account balance. The two, so first of all, know how we credit it. First of all, if money comes into the account, it goes down as a positive. So for example, if we sell a car to another nation, okay, and the other nation sends us money, that goes down as a positive in our current account. Why the current account? Because it was the exchange of a good or a service. Okay, and it's a positive because they bought it from us and sent us the money comes in. Okay, if other countries buy our stocks and bonds, that goes as a positive in the capital account. Again, why the capital account? Because it's investment. Why positive? Because money comes in. When money goes out, it gets credited as a negative. So when we buy something from another country, or when we invest in another country, money leaves our country, and that account, whether current or capital, gets credited with a negative. Okay, so that's another important thing. Make sure you know how to credit each account. Now, here's the rule. The two accounts, when you put them together, they have to balance, or in other words, equal zero. So in other words, if the current account is, let's say, the current account is positive 20 billion. Okay, if the current account is positive 20 billion, that means that the capital account is going to be negative 20 billion. And so forth. Okay, so if you put the two together, they will equal to zero. If this one was negative 50 billion, this would be positive 50 billion, and so forth. Okay, the two accounts, you put them together, they always equal zero. Why is that? Okay, well, again, this is explaining how the money always makes its way back. So, let's say, for example, that we buy a lot of products from Japan. Okay, now we're buying from Japan, sending money to Japan, products, goods and services, so that's going to put our current account in deficit. Okay, now, Japan has a bunch of our money. What are they going to do with this money? They're going to do one of two things. They're either going to turn around and take that, because they don't use American currency in Japan, they use yen, all right? So what do they do with currency? They're either going to take our money and turn around and buy our things. So if they bought if we buy $10 million worth of stuff from them, and they turn around and buy $10 million worth of stuff from us, well, that puts the current account in balance. It's just zero, right? Because it canceled out. What they're probably more likely to do is take that money and turn around and invest it or reinvest it back in America. And that puts our capital account in surplus. So where the current account started out in deficit because we bought from other countries and money got sent to other countries, when they send that money back and reinvest in America, our capital account becomes positive. And in fact, this is exactly what happened in the 1980s, 70s, and 80s. Remember, we talked about how Japan started to overtake our car market. We started buying a lot of Japanese cars in the 70s and 80s. Well, when we buy cars from Japan, again, we send money to Japan, our current account goes negative. Now Japan's got all this money. What are they going to do with it? They can wallpaper their homes with it, which isn't very practical, or they can either buy stuff from us or reinvest it in us. And what they decided to do is they said, hey, Americans seem to like our cars. Instead of building them in Japan and then shipping them across an ocean, which is expensive, let's just build the daggone factory in America. Okay, why not Georgetown, Kentucky, of all places? I don't know why, but what they did is they took all that money we had been sending them to buy their cars, and they came back and they reinvested it in us. And now our capital account goes positive. Same thing has happened in the last 20 years with China. We've been buying a lot of stuff from China, right? More than they bought from us. So as we buy stuff from China, our money goes to China. Oh my gosh, what are they going to do with that money? Well, what they've been doing is turning around and buying our bonds, especially as we've been going through in the late 2000s. We talked about the housing market collapse and the Great Recession, whatever you want to call it. Okay, so the government spent a lot of money. They had to borrow a lot of money to spend a lot of money to deal with the crisis. And so where do they get that money from? Well, a lot of it came from China. We had sent money over to them to buy their stuff. They turned right around and bought our bonds, bought our government debt, in other words, and that makes our capital account positive. So the current account is negative, the capital account is positive. And so in the long run, trade always balances. The money makes its way back one way or another, and that's why, like I say, I don't get my drawers in a twist over trade deficits and whatnot or surpluses. It all works out in the end anyway, okay? As we look at currency exchange, we're going to see even more how the exchange of currency causes things to balance. It changes the value of currency and causes things to balance, but that's a story for another day. So at this point, a couple just simple things. Again, the definition of current account, the exchange of goods and services. Capital account measures the exchange of investments. Okay, know the concept when money comes in, it's a positive, money goes out negative, and the two accounts always balance. If you know that, you got everything you need to know about current and capital accounts. So there you go. If you have any questions, let me know. And until next time, stay healthy and happy.